proper position sizing for traders and investors is, in my view, the Achilles heel for many of them. We know that most self-directed investors and traders actually underperform people that are either allocating with an investment advisor or people that are just doing passive investing and through an allocation program. The self-directed trader and investor typically tends to do worse, largely in part of position sizing, which can be rooted back to fear and greed, by the way. But let's focus on the practical part of it. And I would argue that if proper position sizing were to be implemented by traders and investors that are self-directed, I would argue that the average investor and trader that's self-directed would probably almost immediately either turn profitable or lose a lot less money. Let's put it that way, like small drawdowns, which is a big thing. Hey everybody, Serge Berger here from the Steady Wealth Podcast. For position sizing, what is it? I'm going to give you a specific formula here as well, is today's topic. A quick preview to next week, if I may. Next week, we are starting a new chapter, or adding a new chapter, if you will, to our Steady Wealth Podcast, in which we are going to start having interviews with fund managers. Let's put it that way. We're going to start off with an ETF company that runs all sorts of different really interesting strategies with their ETFs. And I'm really looking forward to that discussion. So make sure you tune in next week as well. But let's talk about position sizing and why that's so important. As always, I'm going to be discussing a few points here. I will be sharing a screen. So if you're watching this on YouTube, you will be seeing the screen. If you're listening to the traditional podcast channels, you will be hearing what I'm talking about. You're not going to miss a thing, so do not worry about that. But let's talk a little bit about what is position sizing and why is it so important. First of all, position sizing essentially is the amount of capital that we want to put into any given trade or investment as it relates to the individual position that we're considering. And essentially, I would argue there's really only 3 points of why position sizing is so important. So let me quickly run right through them. Number 1, proper position sizing, in my view, allows us to avoid catastrophic losses. In other words, proper position sizing helps us limit the impact of a single trade or investment gone wrong on our overall portfolio. We've all heard it before. We've probably all done it before, where you have some sort of conviction in one trade or an investment and it goes wrong, it's overly sized, and because it's overly sized, we don't get out and we lose way too much money. There is, on point 1, while we're at it, a caveat. So for example, Stan Druckenmiller, who is arguably one of the most, if not the most successful hedge fund managers of all time, I think he averaged 30+% for a long time. I don't want to say how many years, because I had many years. And his position sizing kind of goes completely contrary to what I'm about to talk about. He talks about having a few eggs in a basket and basically overly allocate to all of them. But he has an uncanny ability, and he's one of the very few exceptions, an uncanny ability of knowing when he's wrong and then very quickly switching his position. Most investors and traders, particularly do-it-yourselfers at home, have absolutely no chance of doing that empirically. And by trying to do that, you're just completely going against the odds. So I do not suggest that. Stan is an outlier there. And for most people, having a proper position sizing through a lens of sort of portfolio theory, if you will, makes a lot of sense. Number 2, why is important? Position sizing is so important. Managing risk effectively, right? In other words, it's crucially important to risk manage. Risk management, part of risk management is position sizing. In fact, it's not just a part, it might be the vast majority of it. And so we want to make sure we don't take up too much risk capital on a single trade. Thirdly, it allows us to have a balanced return and risk. So if we find the right position size, it allows us to optimize returns while staying within our risk tolerance. Now, some of you folks that are listening to this right now might be saying, you know what, I only trade part-time with a small trading portfolio, and hence this doesn't matter. I would very much disagree. It actually may matter even more for you, because if you're not doing this full-time, you're not managing your IRA or 401k full-time, you're not even working with an investment advisor, you are probably even more at risk than some people who actually do this full-time, who do tend to focus a little bit on risk management, arguably way too little. Before we continue on this, let me give us some perspective what we're seeing in terms of what's taking place out there. This week, I had several conversations with our entire community of different products we have, and I made a very big point of how I think, from what we're seeing from institutional conversations, even from what we're hearing from the authorities of several countries, the United States and Europe, and even parts of Asia, that they are aware of what I think they're all agreeing, and I'm definitely agreeing because I'm seeing it too. We have a gambling bubble. We have a giant gambling bubble by the retail investor. And this is different than what we had, for example, in the dot-com bubble, where, yes, lots of people were gambling, but the amount of people, the people that were gambling, for the most part, had to have access to a broker account, which is a bit more difficult than nowadays. We've got the phones, we've got our mobile phones, we've got our apps, such as certain types of brokers that have confetti flying through the screen when we put on a trade. All of that gamification, all that gamification has essentially turned this entire exercise over the past 15 years into one giant casino out there that we've never seen before, because now everyone's involved, and it's, in our view, extremely risky. So that's all the more reason why position sizing right now should be, in our opinion, on everyone's radar, to be something to learn. Yet we see very few people caring about it because everyone's in this frenzy of just chart chasing, is the word I like to use, things to the upside. So for proper position sizing, of course, there's no hard and fast rule. None of this here is investing advice, but I'm going to give you a specific formula. But in order to understand the formula, let me give you some visuals as to why this is so important. So for those of you guys that are seeing the screen right now, if you can't, do not worry. It's not a big deal at all. What we're looking at here is a chart of Tesla at the top, just a normal price chart, most simple thing in the world. At the bottom, we have something called the historical volatility of that specific stock. And what we're seeing here is that this is a volatile stock, right? No shit, Sherlock. Everyone knows that Tesla is a volatile stock. And you can see that sometimes it has a volatility of 20. If you need the definition of volatility, we will cover that another time. And sometimes it has a volatility of as high as 120. I would say the average volatility, eyeballing this here, is for Tesla is probably somewhere around 70 or so over the course of a number of years. So it's a volatile stock. If I juxtapose that to, let's say, shares of Procter & Gamble, which, by the way, actually right now, again, not investment advice, to us look pretty attractive on the upside. This is a stock that has an average volatility over the course of many years that's probably closer to 20 or lower. So again, we're looking at Tesla that has an average volatility of around 60. Is, again, I'm eyeballing this here. I could put a moving average on it and get you a closer number. That's roughly what I'm imagining or seeing here. And Procter & Gamble has an average volatility of about 20. Definition of volatility aside, I think everyone can understand that 60 is larger than 20. In fact, 60 is 3 times larger than 20, right? And when I'm looking at this let's start from a trader's perspective. If I'm a trader and I would put on a trade here, I would have put on a swing trade, a position trade, hold it for a few days, a few weeks, I would be well advised to consider a smaller position size in Tesla than I would do in Procter & Gamble. And we can go down this rabbit hole of the psychological aspect of all this, which is very important. But I think everyone can understand that the volatility ultimately can lead to a problem. Not only will the higher volatility does not mean that Tesla is a riskier stock in terms of, that the risk of the stock collapsing is higher necessarily. It just means that the gyrations of the stock are higher than the daily gyrations of Procter & Gamble, and here's the psychological part. And what happens if I, let's say, invest $5,000 into shares of Tesla or options of Tesla, and I do the same thing with Procter & Gamble. I buy $5,000 worth of shares or $5,000 worth of options. Obviously, if one trades with options, one would proportionally invest with put a lot less capital to work in an option trade than in a underlying equity trade, just for disclosure purposes. But let's just roll with the 5,000 number just for illustration purposes. And Tesla moves a lot more. I'm going to be prone to be subjecting myself to a lot more stress and a lot more of my emotions flaring up, meaning I'm me becoming greedy or fearful when Tesla moves around. Procter and Gamble, on the other hand, I'm not going to get that emotional about because unless there's a bit of a tail event, and even in tail events, Procter and Gamble's volatility for the most part didn't go much above 50 except during COVID, but during COVID Tesla ended up having a volatility of 230. So you can see there's a bit of a thing there that Tesla still ends up being much more volatile. But long story short here, make sure you position size in an appropriate manner that is relative to the stock's volatility. Also, as a side note, an important note, we, as a general rule, here at the Steady Trader, also over at Blue Marlin Advisors, which is our investment advisory firm, we will not hold trades, like pure trades, swing trades positions through earnings reports of an individual company. So that is also another way to sidestep a little bit of volatility over time. So let's talk a little bit about account risk. And I'm not going to go through a different chart. I'm just going to talk to you about what these are. The formula basically. So account risk, I'm talking about the formula. For the most part, what we are seeing is that a good rule of thumb, and again, not investment advice, is to not risk more than 2% of one's investment capital to any given trade for the most part. Sadly, right now, what we're seeing is people doing a lot more. And that goes back to my gambling bubble right now. Remember, I said we have a gambling problem in the markets right now, more than ever. That's not a valuation call in the market. That's a gambling trouble, and ultimately we're going to have unfortunately, a very big price to pay, especially baby boomers right now, or people between 55 and let's say 75 who are essentially now gambling in many ways with their retirement funds. So just a bit of a word of caution for what we're seeing. For example, and I, in full disclosure, I took this from Investopedia because I think it's an actual really good example. If an investor, and I quote, has a $25,000 account, like let's say this is the trading account that someone is trading with, and they want to set aside a maximum risk of 2% per trade, they essentially can't risk more than $500 per trade. And now you may want to ask yourself, is your account more or less? Or is it around to that $25,000? And I'm just roughly speaking. And if so, are you risking more than 2% on any given trade? And for most people, the answer is probably yes, if they have a $20,000 account or less. And that can be a problem depending on the strategy. There are certain strategies where I would have no problem going 5 or 10% allocation, but it really depends on the strategy and how overall the strategy and the amount of money you have set aside, in this case for trading, fits into your overall net worth, your risk parameters, et cetera, et cetera. So even if the investor were to lose, in this case, 10 consecutive trades in a row, they would have only, quote unquote, lost 20% of their investment capital. So meaning the $25,000 account would now be worth $20,000. But a lot of people after 10 consecutive trading losses probably have cut their portfolio in half. So that's an issue. I think what's most important here as a takeaway from this just quick point about risk management is that risk management, whether it's for trading or investing, can be made a lot easier a task if we position size properly. Meaning, again, if we don't allocate the same amount of money to every single trade, regardless of the underlying stock, ETFs, future contracts, whatever it is, volatility. Look, it's a difficult business. Trading and investing is hard to do, at least for most people, I would say. And why not make it a little bit easier? I know, for example, for me, if I have smaller position sizes, I tend to be a lot less emotional about my trading, investing in my positions. And I would encourage everyone to try that. Yes, it's hard to hit a home run, But home run strategies also tend to blow up over time. It typically tends to be more a question of time. It's more a when rather than an if. And so we want to avoid account blowups because we need to be in this for the long haul. Trading and investing, if it's done, is a long term game. We're not trying to hit a home run every time. And again, typically home run strategies or home run attempts tend to blow up quite spectacularly for most people who try to do that, and that really defeats the purpose. So proper risk management starts, in our review, with position sizing. Yes, of course, we need to have stop losses. We need to have profit targets in place. That's a topic for a separate podcast, but I thought I'd give you an idea. So 2% position sizing for a trade, to me, I can get my head around that. If we're talking about investing, however, I would feel comfortable going 5, potentially 10 or even 20% on positions. I think right now, if I'm looking at my portfolio, I would say that I probably have about 25% of my invested capital in like the liquid portfolios, not like in like real estate or anything like that, is probably in gold. That's not investment advice. I'm just trying to give you an example of like how, from an investing perspective, where there's a much longer time horizon, and gold is also not as volatile as something like Tesla. Right now, gold can be volatile, make no mistake about it, but it typically tends to not be as volatile as any given, let's say, tech stock within a moderate capitalization. So from an investing horizon perspective, I would lean towards closer 5 to 10% per position allocation, maybe to the lower end of that. But again, if it's something that has lower volatility, depending on the environment, and we want to have sort of a more of a portfolio protection posturing, then again, with 20-25% allocation in gold right now, I may be stretching those limits, but I'm just trying to tell you there might be a exception to the rules in an investing environment. From a trading environment perspective, again, 2-3% or so in any given trade is probably about what I would say makes sense. So go through your portfolio, folks, and look at how your position sizing, given the gambling nature that we have in the market right now. And again, a lot of people are aware of this. Government authorities are aware of it. Big institutional investors are aware of it, and they're changing their portfolios accordingly. And there's real risk here of a lot of baby boomers blowing up their portfolios, and that's going to cause issues down the road, not only for them, but also for the markets. Position sizing, please look into it. Please educate yourself on it. I hope this served as a little bit of a primer. And if you have any questions, always let us know. Come back next week, folks. I'm super excited to start the next chapter in our podcasting, and we're going to start interviewing and having great conversations. I can't wait. I'm so excited to see what these conversations are going to bring with investment managers. We're going to start off with an ETF manager that offers some really cool strategies, and I will be excited to see what you guys' feedback on that is as well. Thanks for listening. That's it for this episode of the Steady Wealth Podcast. Be well, trading well, and again, risk management is important. Talk to you soon.